Hello everyone, I am Udari and this is Kenneth. Today we are presenting our optimization methods assignment on cardinality-constrained portfolio optimization for the Colombo Stock Exchange. We compare two methods, branch and bound as our exact method and a genetic algorithm as our metaheuristic. We will go through problem selection, data description, mathematical formulation, both optimization methods, implementation, results and discussion.
Sri Lanka has over 290 listed stocks, but no accessible algorithmic tool for everyday retail investors, people rely on broker tips and guesswork after the 2022 for in-depth crisis. There is a renewed urgency for disciplined investment decisions. This problem is genuinely non-trivial. If we want to pick the best 8 stock from 96, the number of possible combination is combination 9 to the 8, approximately 42 billion subsets. We cannot try them all. Brute force would take 48 days of compute time. This is what make it's a real optimization challenge.
We use real stock data, real CSE stock data downloaded via the Wi-Finance API. 96 stocks across 14 sectors from January 2020 to December 2025. We did not use synthetic data. The data went through four-stage pipeline. First, we filtered out tickers with insufficient history. Then, we imputed missing values using forward and backward filling. We clipped extreme daily returns at plus or minus 50% to remove anomalies. Finally, we annualized everything using 240 CSE trading days per year. This pipeline produces three outputs that feed directly into the optimizer: the expected returns, vector mu, the covariance matrix sigma, and sector labels for diversification constraint. These are the parameters Kmax, Wmin, Wmax, fixed free rate, trading days. Our model has 5 constraints. The budget constraint ensures all capital is invested. The cardinality constraint limits the portfolio to at most 8 stocks. This is the key constraint that makes the problem hard. The minimum position constraint ensures each selected stock gets at least 3%, no negligible allocations. The maximum position caps any single stock at 40% to prevent concentration risk, and we enforce long only. The most important constraint is C2. It forces binary variables into the model. Either you hold a stock or you do not, and this is what transforms the problem from a simple quadratic program into mixed integer quadratic program, which is NP hard.
This objective is to minimize the Sharpe ratio, portfolio return minus the risk-free rate divided by portfolio volatility. We use 10% as the risk-free rate and consistent with Sri Lanka's T-bill rates. The challenge is that the Sharpe ratio is non-linear. The weight appears on both the top and the bottom of the fractions simultaneously. Standard solvers cannot optimize this directly. So we use a reformulation. Instead of maximizing the ratio, we fix a target return tau and minimize portfolio variance. We sweep tau from the minimum achievable return up to the maximum, collect the Sharpe at each point, and select the portfolio with the highest Sharpe. This convert one hard nonlinear problem into many easy quadratic programs.
Our first method is branch and bound. This is an exact algorithm. It works in 3 steps. First, it branches. At each node, it decides whether to include it or exclude the next asset, building a search tree. Second, it bounds. For each partial solution, it solves a relaxed version of the problem to compute an upper bound on the best possible Sharpe achievable from the branch. Third, it prunes. If the upper bound is less than or equal to the best solution already found, the entire branch is discarded without exploring further. We also used a warm start, selecting the top k assets by individual Sharpe ratio to give a branch and bound a strong starting point from the beginning.
Our second method is genetic algorithm implemented using deep library in Python. Each individual in the population is a binary chromosome of length 96. 1 means that stock is selected. 0 means is that it is not. The fitness of the each individual is the Sharpe ratio after running SLS-QP optimization to find the optimal weights for that subset of stocks. We use tournament selection, uniform crossover at 85% rate, and bit flip mutation at 10% per gene. Repair operations enforces the cardinality constraints after every crossover and mutation. If more than 8 stocks are selected, the lowest performing ones are dropped. Why did we choose these two methods together? They are complementary by design. Branch and bound give us the optimality guarantee. If it completes, the solution is probably the best possible. This make is the gold standard benchmark, but it becomes impractical for large uh, in stocks because runtimes grows exponentially. The genetic algorithm scales to the full 96 stocks universe with the fixed computational budget. It cannot guarantee the optimality, but it explores as much wider search space within the same time. Together, they allow us to measure the optimality gap precisely. In our case, approximately 5%, which quantifies exactly how much solution quality the genetic algorithm trades for our scalability.
Moving to the implementation, we have uploaded it to the GitHub using single Jupyter notebook. We use Python with NumPy, Pandas, SciPy libraries, and the deep library for genetic algorithm, Y-Finance for data, and Matplotlib for visualization. The branch and bound implemented as a custom recursive class with upper bound computation via CLSQP. These are the screenshots of the main function. The GA uses deep simple algorithm with our custom evaluate and repair functions. The random seed is fixed to 42 throughout full reproducibility. These are the main functions of the genetic algorithm as well. These are in the notebook which is uploaded into GitHub. Talking about the results, here are the headline results side by side. Branch and Brown achieved a Sharpe of 1.8160, return of 48.66%, volatility of 21%, 29% in 120 seconds, evaluating 441 solutions. In the other hand, genetic algorithm achieved a Sharpe ratio of 1.9072, which is greater than branch and bound, return of 45%, which is greater than branch and bound, volatility of 18.5, which is lower than branch and bound in 729 seconds with the 1280 evaluations. The GA sharp is higher than branch and bound, and this is not a contradiction. Branch and bound explored only 441 out of billions of possible subsets before hitting the 120-second time limit. The genetic algorithm's 1280 evaluations covered a much wider search space and discovered better sector combinations that branch and bound's greedy initialized truncated search never reached. The optimality gap is 5% or 2.
Looking at the actual stock selection, both methods agree on five common holdings. Uh, and the fact that two completely different algorithms independently select same five stocks is strong evidence these assets genuinely dominate the CSE, efficient frontier under the constraint. The method diverge in their remaining three selections. Branch and Bound considered heavily in diversified holdings, giving it a sector allocation of 41%. Uh, the genetic algorithm instead moved into the food and beverages, achieving better diversification across six sectors. This broader sector spread is what drove the genetic algorithm's lower volatility of 18.5%. Looking at the panel A shows a uh, genetic algorithm convergence, the best fitness cross the branch and bound benchmark of 1.8 within the first 15 generation and stabilize at 1.9 by around the generation 40. The population average stayed consistently below the best throughout the confirming diversity was maintained. Panel B shows the weight allocated allocation side by side. You can see the five shared stock as the paired bars and the three diverse selections clearly. Panel C is the risk return chart. Both portfolios are positioned above and the left of the entire grey dot cloud of 96 individual stocks, meaning both achieve return and risk combination that no signal CSE stock could deliver alone. This is a diversification benefit confirmed empirically. Panel D shows the sector split. Branch and bound heavily diversified, and the genetic algorithm spread across food, banking, manufacturing, energy, and hotels.
Moving into the scalability, for the scalability experiment, we tested both methods on synthetic instances from n equals up to 10 to 30 assets with k equals 5. The most striking finding is the optimality gap column. All values are effectively 0. The y-axis on the gap chart reads 10 to the power of negative 13. These are floating point rounding errors, not real differences. For every instance up to n equals 25, both methods found identical portfolios. The GA independently located the same globally optimal solution that Branch and Bound certified as exact. This cross-validates both implementations. At n equal 30, Branch and Bound hits its 30-second limit. The runtime chart on log scale shows Branch and Bound growing with n while GA stays flat. A direct consequences of GA's fixed evaluation budget. For the full 96 stock universe, Branch and Bound is computationally intractable, and genetic algorithm is the only practical option. Moving into the key findings, there are 4 key findings. First, GA outperformed Branch and Bound due to Branch and Bound time limited truncated search, which is not a theoretical failure. Second, both portfolios achieve risk return combinations unreachable by any individual CSE stock, confirming the Markowitz diversification principle on real emerging market data. Third, 0% scalability gap cross-validates both implementations for small n. Fourth, 5 shared holdings cross both methods confirm the assets genuinely dominate the CSE frontier.
There are few limitations in our model. First is it is a single period model. We optimize the portfolio once using the historical data and assume those weight will stay fixed. In reality, real investor rebalances the periodically as the market conditions changes. Our model does not account for this. Second, expected returns are estimated from historical data. Third, transaction costs are not modeled. Every time you buy or sell a stock on the CSE, you pay a brokerage fee. A portfolio that looks optimal on the paper may become suboptimal once trading costs are factored in. In the future, we plan to work on the most important aspect is multi-period rebalancing with the turnover cost, optimizing not just the initial portfolio but also how it should be updated over time while minimizing the trade cost. Also, we are planning to work on uh, hybrid branch and bound and genetic algorithm approach, using a genetic algorithm to generate a strong warm start for branch and bound. This would give branch and bound much better starting increment, tighten the bound from the beginning, and potentially close the 5% optimality gap we observe.
Thank you.